Hello, everyone, and happy Friday. This is Tom from MarketsFlow. It is the 8th of November, and we're recording this partway through Friday as we bring you this weekly performance for the week ending 8th of November 2019. I'm here with Adam. How's your day been, Adam?
Oh, I'm fine, thanks, Tom. It's been okay. I have a decent cup of coffee in front of me.
Good. All caffeined up then. Right, so let's get started. This is the Webcast 28 for MarketsFlow's portfolio performance for week ending 8th of November. Our podcast is recorded every Friday and it's uploaded immediately on YouTube. Please subscribe to our channel so that you can receive it as soon as it's made available. MarketsFlow is an FCA authorized robo-advisor and digital wealth manager. Your deposits are protected by the FSCS for up to £85,000. Go to marketsflow.com to learn more about our portfolio performances. You can download our mobile app on the App Store or download it on Google Play. You can sign up and start investing from £10. Before we start, I'd like to run through our disclosure. Your capital is at risk and any financial performance figures refer to the past, and that past is not a reliable indicator for the future. So having said that, let's cover the important subject. How did the portfolios perform this week, Adam?
Well, up to now, and as usual, we're not talking at the very end of Friday. We've still got a few hours left, a couple of hours left to go before the market closes. A high growth portfolio is up 0.2% this week, and that means we're up 7.47 since the launch of accessible portfolios at the start of June. The growth portfolio is up 0.18% this week and 7.36 since that date in early June. And the ISA portfolio is up 0.15 this week and up 4.64 since that early June launch.
Great. Thank you, Adam. And how has that fared with the market?
Well, at the same time as I measured the portfolios, I measured the market, meaning S&P 500, and that was up 0.59%, measured from last Friday's close. The index stayed in an even tighter range actually than last week, which was already a fairly low volatility week. But you know, we keep on touching those new highs repeatedly. But against this almost eerie absence of volatility, it's quite a strange market.
Yes, that's right. So how were the allocations within the portfolios?
Well, the portfolios are generally less allocated this week than last. Rarely anything more than about 30% allocated. All the activity was in stocks, no options activity. Options premium was just pretty scarce because volatility was so low.
Yes, that's right, and it's fair to say that we're going quite light going into the next week. Would that be right?
Yes, absolutely. And on talking of that and how we were risk managed in general through the week, with the overall market on aggregate scarcely moving at all, but underneath the surface, fairly significant dispersion across the components that make up the market. Stock picking was really the best place to go for performance, so that's where the focus was. Plus, as usual, the general disciplines that we keep to, the setting stops for both for gains and for losses that are appropriate and proportionate to the sort of market regime that's going on, and sticking to those, not being too greedy.
Right. Okay. And what do we need to look forward to from here on over the next week or two?
Well, I think we can pretty much stop talking about earnings now, with that season largely having passed, and we'll come back to that in January. But we are into a period of monetary easing by at least half of the world's central banks, and most importantly by the Fed. We've talked about that before. And we're in the period now where the countries are starting to announce their third quarter GDP, or at least their initial estimates of it, which are often a little incomplete in terms of hard data, partly made up of sampling and statistical techniques and subject to some later revision. Nevertheless, because they are the only taste you get at this stage of GDP, for example, we had the US last week looking a little stronger than had been expected. This is important news, even if it is later revised a little. So I would say that we're going to continue to have the market looking at and commentators talking about these GDP releases as they come out, and they add, together with all the other economic data that central banks are waiting for, just to see, just to either validate or alter the way that they will set rates. from here over the next months and quarters.
Okay, very useful. Thank you, Adam. So that brings us to the end of our podcast. Thanks for watching or listening to us on YouTube. Please remember to subscribe to our channel. Have a great weekend, and we look forward to our next Friday's podcast. Take care. Bye-bye.